Hey everyone, and welcome back to another portfolio update. So for the week, huge underperformance yet again. We're down 4.88%, whereas the S&P 500 was down 1.48%. Now, what's interesting here is that at one point, if we look at year-to-date performance, at one point we were only down, well actually on Tuesday that was, we were only down 1.84% year to date, whereas the S&P 500 was still down 2%. But then, as the Lil Wayne Jay Sean lyrics go, baby, are you down, down, down? Yes, we are down and then some. Now in today's video, as always, we're going to go over the activity in the portfolio. Spoiler alert, not much has happened, but I did increase the cash position finally after waiting for a while. Did increase the cash position, did sell and buy another company. You probably already know which one that is. And I plan on buying way more in the coming days as well. A lot of stocks that I own got hit, look very cheap. So I'll take the opportunity to add more shares to those positions. Now, April 2nd, the big tariff deadline day, I already made a specific video about that, Tom Lee's projection, my own projections, etc., etc. But yeah, basically, during that day, we hopefully will get way more information. Who gets hit, how much, when, why, how, all of these questions hopefully will get answered on April 2nd. Then we also have to talk a little bit about the consumer sentiment, right? It's always consumer sentiment surveys. As you know, some of them are politically, I won't say motivated, but you can either be very bullish because, well, you're, I don't know, conservative, and then you can be very bearish if you are not conservative. So take these surveys with a grain of salt. What's important is to look at the hard data. So far, hard data does not indicate a recession anytime soon. So let's talk about all of that in this video. Hit all the buttons, we really appreciate that, especially if you subscribe, trying to reach 90,000 subscribers, and then we're going to try to reach 100. So hit that subscribe button, it's free, so why not? All right, so first up, the Friday picture. Not a pretty picture at all, right? Complete destruction here, especially in the tech space. As always, healthcare and consumer non-durables, utilities actually still doing quite well. These three categories, as you've seen in the live streams, have been doing very, very well. Technology and all of that did not perform as intended, and that is definitely an understatement. Now I'm laughing because this is how we cope. So yeah, not a pretty picture. Moving on here to the consumer sentiment. So this is from the Wall Street Journal. Consumers' moods are in March with gloomier economic outlook. A University of Michigan survey's poorest results since 2022 reflect economic policy anxiety. Now, just an FYI, in 2022, bear market, I mean, worse than what we are today. In 2022, inflation started to go up quite rapidly. Interest rates are going up rapidly. I don't think we are in the same position right now. Far from it. But of course, if you want to be bearish, you can definitely be bearish today. So the survey's headline index came in at 57 this month, the lowest level since 2022. That marked a decline from 64.7 in February and 79.4 a year ago. Data published earlier this month had shown a preliminary reading of 57.9. Now, 2/3 of consumers said they expect higher unemployment in the next year, the highest reading since 2009. Again, this does not tell us much, right? Because unemployment is still very, very low. So higher unemployment in the next year could mean that we're going from 4.3 to maybe 4.4, maybe 4.5, which is still very, very far away from that 5+%. They continued here. The potential for higher inflation remains a key concern among people surveyed by the University of Michigan. Respondents said in March they think prices will rise by 5% over the next year, up from 2.8% expected inflation at the end of 2024. On Friday, the Fed's preferred metric of inflation rose back to 2.8%. I believe the expected number was 2.7% or something like that for the 12 months through February, excluding volatile food and energy prices. I do believe that energy prices are coming down. Now, just so you get the big picture here, this is University of Michigan's consumer sentiment. Right now, yes, we are the lowest since 2022, but in 2022, June 2022, we're already full-on bear market, higher inflation. Inflation was not transitory, super high interest rates are coming. So this was the lowest point, okay? COVID crash. March, COVID crash. Or May, this was May maybe, 70. So we are lower now than we were when the pandemic started, but at least at the moment we are still a bit higher than the horrible period we were here back in June of 2022. Again, it's a consumer sentiment survey. You can write whatever you feel on that specific day. So far, hard data on what actually happened in the economy have indicated limited slowing. There hasn't been a big rise in layoffs and unemployment remains in check, although the pace of job creation has slowed. The Commerce Department report published Friday morning showed that personal spending actually rose by 0.4% in February from January, less than the 0.5% that economists had been expecting. As of now, I would call it an economy going at stall speed, according to chief economist at Piper Sandler, an investment bank. Which again, to me, I don't think we're going to go in a recession. Now remember, back in 2022, there was also a talk of, recession, right? And everybody wanted to actually change the definition of a recession. Because back in 2022, Q1 2022, as you can see, GDP growth was actually negative 1%. By the way, back here in 2022, when we started the pandemic, also, actually we had a recession since those are 2 consecutive quarters of declines. Here we only had 1 quarter of a decline, and then we started to go back up. Now, yes, currently it's true that maybe Q1 of 2025 we're going to see GDP maybe being negative. That might definitely be impacted by all the imports that have happened pre-tariffs. Or we could also see GDP growth decelerate quite a lot, being low. That's also a possibility. But as long as it's not negative, or as long as it's not 2 consecutive quarters of negative GDP growth, we cannot say that this is a recession. And yes, I'm sure, and this is already my prediction, I'm sure we're going to hear a lot of CEOs that if next quarter they are underperforming, they are going to blame the macroeconomic environment, slow in spending, etc., etc. Yes, definitely possible, which again, on the one side, can be very, very true. I think Lululemon CEO said it as well. But then again, if you are, let's say, not comfortable with the economic situation right now, then maybe you will not spend on expensive yoga pants. Could very well be, right? But then on the flip side, some CEOs, some management will definitely use this macro uncertainty to maybe hide business-specific issues. Has happened before, will happen again in the future. But so far, looking at the data, I don't think it is Armageddon just yet. Although plenty of folks like to use this doomsday scenario to create even more panic. But as investors, you zoom out, you look in the long term and you're like, does it make sense? Do I have to be scared out of the market right now? Yes or no? Me personally, clearly not, right? 2022, clear buying opportunity. 2024, in my opinion, clear buying opportunity as well. Plus, by the way, we just came from 2 years of plus 20% year-over-year increases for the market, right? The returns in 2023 and 2024 were above 20%. It's pretty good. So having a little pullback at the start of 2025, big freaking deal. Now, just so we're clear, me seeing my stocks, my portfolio go down, of course, it's not enjoyable. But me seeing a Google at $154, a PayPal back at $65, and of course Google has to turn up yet again. This is the perks of having a Pixel phone. But okay, me seeing these prices right now does not make me like, super angry. Oh no, I'm not taking the opportunity. No, I'm seeing these prices and I'm like, okay, not good. We're down 9.6% year to date. Okay, but we're still up since the start of this portfolio. 44%, we're still beating the market quite comfortably. All in all, my positions, some positions are now in the red, but all in all, I think I'm still doing quite well. So I don't like the fact that I'm down year to date at the moment, but I'm also not complaining that I have opportunities to buy more shares of great companies for the future. Because like I said, bear market or the huge crash in 2020, buying opportunity. 2018 trade war with China, buying opportunity. 2022 bear market, huge buying opportunity. So you have to take the opportunities during bear markets. When everybody's bearish, usually you should be very, very bullish. Now, of course, I'm not telling you to just buy everything every single time. No, have cash and then add a little bit here, a little bit there, because yes, lower can go lower. So it's important to note that what you're buying makes sense. The value that you're paying today makes sense. And if it goes lower, great. Prime example is, of course, my AMD position, right? Previously, I did not like AMD when it was at $150 or $200. No, it didn't make much sense to me. But AMD started to go down more and more. The business started to perform better and better. And I was like, okay, you know what? 115, 110, I already like it at that price. So I started buying. Of course, it went lower, went to 100, then even under 100, kept on buying. And right now it is here, the number 10 position. And probably next week I will have my 100 shares in AMD. The same for plenty of other stocks here. Now, you might have noticed that Disney does not exist anymore in my portfolio. Yeah, I did sell Disney because I wanted to have an opportunity to finally buy Nebius. And Nebius, I am already down close to 10%. I believe I bought the stock at, let's see, at $24.77. Currently only 200 shares of Nebius. So that's the situation here with that position. And yes, I do plan on increasing that position in the next coming days. I did inject a little bit more cash in the portfolio, $5,000 again in the portfolio. Took a while, but then again, I was happy that I had to wait because that means that I did not rush to buy previously, even though, like I said, I wouldn't have mind buying before. But of course, now I can buy just more with the same amount of cash. So yes, in the coming days, I fully expect myself to buy more Nebius, more AMD, probably more Alphabet as well. With regards to Alibaba, I'm still very, very happy with the performance. I mean, I'm still up over 50% on that position, which could mean that I will maybe take some profits in Alibaba if I see that I want or I need more cash to add to some of the other positions in the portfolio, for example, AD local or something like that. So yeah, Alibaba was the contrarian trade for me going into 2025. It worked out much better, well, much quicker. So it makes sense for me to maybe take some profits there, although I still think that Alibaba will go much higher, but it is now the number 5 position in the portfolio, has outperformed by quite a lot. And so I might want to take some profits, secure that, and then put it into other companies in the portfolio. No, currently I don't see myself opening up other positions. I did open up Nebius, but that was just because I did a switcheroo with Disney. Yes, I still have these smaller ones here in Celsius, Upsellera and Owlet. Probably I'll sell them at a loss eventually if I really need more cash and see something else. The Nvidia one here is just 1 share. Don't ask too many questions. By the way, just so you know, Celsius year to date is up 27%. Just an FYI, pretty funny. But of course, in the last 12 months, it's down 60% or so. So yeah, that's Celsius. And so yes, me personally, I am in a buying mood right now. And I don't think anything will stop me at the moment unless really the economy is completely broken and all the data points point to a really, really big recession. At the moment, I don't think that's the case. Yes, I will probably have more cash ready a month from now when we're going to go into the next earnings season. But right now, I think with the 5,000 that I've just injected, I should be fine for the next couple of weeks. No rush, but I will take my opportunities when I see them. I want to have way more shares in a couple of positions and I'll take those opportunities. I think I'm seeing a lot of good prices. As I said, lower can go lower. But since I like the business, since I like the value that I'm getting today, I don't mind it. I mean, perks of, I guess, being a long-term investor, right? Of course, like I said, it's not great to see your portfolio suffer year to date. But remember, it's what? 3 months? What is it, 3 months in an investor journey? Nothing. Literally nothing. And remember, 2023, 2024, 2 very, very big bullish years. So don't be greedy. Don't complain. Oh, it sucks. No. We just came from back-to-back great return years in the stock market. So 3 months, and actually it's not even 3 months, because January was a pretty good month, or a pretty good start of the year. February started fine, and then it's actually a month and a half where things are not great at the moment. Could have another month, for sure. But right now, if we really look at the data, it's probably mid-February until now the start of April where things weren't great. February, mid-March, things weren't great at all. Then, yeah, we did maybe bottom out a little bit, but still in the red. So when you think about that, it's not the end of the world. It's not the end of the world. Chill out, go out, touch some grass. That's what I did today. So, and it helps, definitely helps. Anyways, that's all I've got to say right now. See you all in the next video. Hit that subscribe button if you're still watching. Thank you, and I see you in the next one. Bye-bye.